Right now, the Roth conversion is the golden child of nearly every finance channel on the internet. Pay the tax today, let the money grow completely tax-free forever, and never hand the government another dime on it. And honestly, for exactly the right person, it is a genuinely brilliant move. But here is what almost nobody tells you. For a huge number of people, a Roth conversion quietly backfires, and they do not find out until years later, when the damage is already done. So today I am going to walk you through the exact situations where converting is a real mistake. First, the simple mechanic underneath all of this. A Roth conversion just means taking money out of a traditional retirement account, the kind where you never paid tax going in, and moving it into a Roth by paying the tax on it now. The entire bet is almost childishly simple. You pay tax at today's rate in order to dodge a higher rate later, which means the whole thing lives or dies on one single question. Will your tax rate be higher or lower in the future? Get that one wrong, and the entire move quietly flips against you. So the first and biggest mistake is converting when you are going to be in a lower tax bracket in retirement than you are in today. If you are still working, earning good money, sitting in your peak income years, and you convert, you are paying tax at the very highest rate of your entire life just to escape a rate that would have been lower anyway. You essentially volunteered to pay the government more than you ever had to. The conversion only makes sense if your future rate is genuinely higher, not lower. Think about it in plain numbers for a second. Convert while you are still earning a high salary, and you might pay a steep rate on every single dollar you move across. But wait until you retire, and your income naturally drops, and that very same money could be converted at a far gentler rate, or sometimes barely taxed at all. Same dollars, same account, wildly different tax bill, decided entirely by the year you choose to do it. The second mistake is converting when you would have to pay the tax bill out of the account itself. Because the real magic of a conversion depends entirely on paying that tax with separate outside cash, so that the full balance makes it into the Roth and grows. If you instead have to skim the tax right off the top of the account, you shrink the very thing you were trying to grow. And if you happen to be under 59.5, that skimmed off portion can even get slapped with a penalty. No outside cash to cover the tax usually means no conversion. The third one quietly ambushes people right around retirement. A conversion deliberately spikes your taxable income for the entire year. And once you are on Medicare, a single high-income year can quietly raise your Medicare premiums 2 full years later, through a sneaky surcharge known as IRMAA. So, a poorly timed conversion can hand you a bigger tax bill and a higher health care bill at the same time. A quiet 1-2 punch that most people never even see coming until it lands. And closely related to that one, if you retire early and you are leaning on Affordable Care Act subsidies to cover your health insurance before Medicare kicks in, a conversion can be brutal, because it inflates your income for the year, and that extra income can wipe those subsidies out completely. The tax you imagine you are saving for later can end up far smaller than the very real subsidy you torch this year. Quick, honest note right in the middle here. None of this is financial advice. It is just the math and the rules as they generally work. Your taxes and your situation are entirely your own, so please run your own numbers. Now, back to it, because the next few mistakes are the ones that catch even careful people. Here is one that almost nobody ever stops to consider. If you are planning to leave that money to charity when you are gone, then converting makes absolutely no sense at all. Because a charity pays exactly zero tax on a traditional retirement account it inherits. So if you go and convert it first, you cheerfully pay a giant tax bill that the charity itself would never, ever have owed. You quite literally set money on fire for no reason whatsoever. The next one is all about time, because time is the real engine of a Roth conversion. That beautiful tax-free growth needs years, ideally whole decades, to outrun the tax you paid up front to get it. So if you are going to need that money in just a few short years, there simply is not enough runway for the growth to ever pay you back for the tax you prepaid. A short time horizon makes for a genuinely weak conversion. And even in the cases where a conversion truly is the right call, doing way too much of it in a single year is its own separate mistake. Convert one enormous chunk all at once, and you can shove yourself straight up into a much higher tax bracket, paying a genuinely punishing rate on that top slice of money. The smart version is to quietly fill up just your current bracket, a measured amount each year, instead of recklessly dumping the whole thing in at once. And here is one last quiet trap, this one about geography. If you happen to be about to move from a high-tax state to a state with no income tax at all for your retirement, then converting before you move means paying state tax that you could have completely, legally avoided. Sometimes the single smartest conversion move there is simply to wait until after you have crossed that state line. So notice the thread running through every one of these. A Roth conversion is not actually good or bad all on its own. It is a tax rate bet, nothing more. And it only truly wins when you convert at a low rate to escape a higher one using outside cash with plenty of time to grow, and without quietly tripping some hidden landmine like IRMAA, lost subsidies, or an early penalty. Line all of that up correctly, and it is genuinely powerful. Get even a couple of those pieces wrong, and you simply prepaid the government for absolutely no reason. Now, to be completely fair, there is a real sweet spot where a conversion genuinely shines. In those early retirement years, after your paycheck has stopped, but before Social Security and required withdrawals begin, your income often quietly drops into a low bracket for a while. That low-income window is the golden time to convert, filling up that cheap bracket on purpose, paying tax at a discount you may genuinely never see again. The mistake was never converting itself. It was converting in the wrong year. So before you ever let anyone smoothly talk you into a Roth conversion, run the whole idea past this entire list first. Because the real question was never whether conversions are good in general. It is whether a conversion is right for you in this specific year, at this specific rate. Tell me in the comments, just type the word skip if even one of these made you rethink a conversion you were considering. And if you want the next breakdown, the one on when a Roth conversion is absolutely, completely worth it, it is waiting for you right now. I read every single one.